All right, what's up?
Hi, my name is Peter, and I would like to thank you for your streams.
You're welcome.
And also, I want to ask you something about software companies. I'm programming and I'm interested in software stocks. What what thing I should know first if I want to do, for example, free cash flow or like deeper analysis of the company, and if you would tell me why is that the software companies have so low margins?
Well, I would look at the gross margins, and the software companies should have very high margins. So, like, because it doesn't cost a lot of money to make software, and the marginal software product is not too expensive. So, if you look at Microsoft, which is the biggest software company, their gross margin is 70-ish%, and they sell hardware. So, like, the normal gross margin is much higher. So, like, AppLovin gross margin is 80-90%. So gross margin should be high. The net margins are often low for a number of reasons. Like if you look at Datadog or like one of these other companies, like Datadog has this very high gross margin, 80% gross margin, but you look at the net income and it's like almost zero. And
Okay.
the reason this happens is like there's a lot of companies that are still in the spend and grow mode. So like you can see like they're still spending a lot on growing their organization. So revenue.
For example,
Yeah.
like HubSpot.
Yeah.
Yeah, sorry.
No, it's fine. HubSpot is a perfectly good one. I mean, I think for most of these companies, it's all about the revenue growth. If the revenue is growing, the stock does great. If the revenue is not growing, it's all over. And it's kind of one of these things where you're trying to achieve scale, and you're willing to spend money to do that, because when you have, huge revenue, then the scale will start to show up, and you'll have like, much better P&L. But it's kind of this weird thing. Like if you and me were going to run a business, we probably would think about it differently, where we were like, no, I want to be profitable. I don't want to be constantly, worried about my profitability. But think about it this way. Like one of the best ways to think about it is the cohort system. So if you think about like, let's say, I don't know if you're watching my screen, but let's say you start a software company. And
yeah, I'm watching from time to time your streams. My name is Peter Foltus, so I was in chat.
Yeah, let me just show you on
opportunity.
Yeah, let me show you on the. Yeah, no, we love having you in the chat. I know exactly who you are, but let me just show you on the stream kind of what I'm talking.
I'll move to my computer and I'll watch a stream, because I turned into phone. I was trying to figure out how to call you.
Yeah.
You are from America, and I try to just
okay. Let me just
copy the number.
Cool.
Yeah,
cool.
I'll be there in a minute.
Okay.
Don't worry. Yeah, okay. I'm clicking on the.
Take your time. Take your time. Okay. So imagine a company that, let's say we're going to call it cohort 1. There's 3 cohorts. Let's make 4, whatever. Okay. So all right. So let's say it's your first year of your software company and you sell 50 million. And of course, your cost of goods sold is small. That's just your programmers mostly. But your sales force is 40 million. And you have an operating profit of 5 million. Great. You have your let's say your sales force is 30 million. You have an operating profit of 15 million. That's a nice little business. 50 million in revenue, 5 million in cost of goods.
Do I make a noise from background? Is everything okay?
Yeah, everything's fine, I think.
Yeah, okay.
So that's cohort 1. Now, if cohort 1 grows, let's say 20%, this is an even better business, right? Because it's, I don't know, they just use the software more or something like that. This price won't really change much. Your cost of goods won't change very much at all. And so your gross profit will be a little better. But what do you do with your sales force? You can keep your sales force the same. If you keep them the same, this will be your profits, right? So what you do is, let's take this on a scratch pad on the side and say, I'm going to already make 25, 36, and 50. That's 111 million the next 3 years. I can basically borrow from this money if I wanted to and hire more salespeople because I know this is coming. Because software, mostly people renew their software. They don't, stop using software once they've started to use it. So you basically
Depends on the software. For example, Monday.com has a lot of turnover, right?
Sometimes, it depends on the kind of software. You have to fight the churn. You're not going to get to 50 million if you have churn, right?
Okay, makes sense.
If you have churn, it's all over for you anyway. But
Okay.
you can also assume that it's not going to grow much, okay? And in which case, this number is more like 45. Fine. But the point is, I can now invest in my sales force. So I'm going to take half of that 45. Let's say I'm going to take 20. And I'm going to invest in my sales force. And my sales force, previously, when I put 30 million, they were able to generate 50 million. Okay? So that sales force will maintain that 50. These guys from the cohort 1 sales team, they're going to now try to sell more. So the existing software sales will stay flat, but let's say they can add another 10 million in revenue from them. And then I added 20 million in more salespeople. And so they should be able to generate almost as much. If 30 could generate 50, how much 20 can generate? Well, that's pretty easy. I divide this by 3 and multiply by 2. Oh, I multiply it by 20, I guess. 33. So this is cohort 2. And now you can see that I've been able to grow pretty substantially by doing this. But one of the things that could happen is that these results would be delayed. So for example, let's shift this a year. Let's shift this a year. And let's say, in fact, the sales are like this. And let's shift this a year and say the sales are like this. This is kind of what more of a software company normally looks like. It's great if you can instantly see productivity, but usually you have these costs that will result in delayed kind of reality. Sometimes it'll even be delayed 2 years.
Yeah, well, whole accounting is basically backward looking, if I'm not mistaken.
Right, exactly. So as you add these cohorts, it can feel like, yes, your revenue is growing, but it doesn't feel like your profit's doing anything. And if I extend this to a third cohort and a fourth cohort, I'll still have operating profit negative, but my revenue will still be growing. But I know that each cohort is actually very profitable. It just takes time to actually get the salespeople trained, get the product launch. So you're always in this game of like, there's a core profitable business. Because again, let's say I take out cohort 2 and I remove cohort 2's costs, I'm very profitable in year 4 of cohort 1. But I have to invest in year 1 and year 2 of cohort 1. And so then year 3 and year 4 are very profitable. In fact, I have almost 50% margins in year 4. But it takes time before that sales force is trained and they can be effective. And in the meantime, I'm going to start investing in cohort 2 and cohort 3 and cohort 4. So that's kind of the idea, I think, behind why some of these companies like Datadog, who's been growing 20, 30, 40% a year forever, really impressive company, has gone from, 800 million in revenue to, now annually like 4 billion in revenue. And HubSpot as well. Or HubSpot is, I was talking about Datadog earlier, but roughly the same kind of economics. So anyway.
Well, I actually used HubSpot in my previous job, and it's a great software. I mean,
yeah, I use it.
You can do some predictions and stuff. I heard that Google was interested in HubSpot, but that price is, it's a high price. And what do you say about that high PE ratio? I know, like,
Yeah, well, that's the thing.
PE
Like,
ratio
you can't
is,
look at the PE ratios because if you look at the PE ratios, you're ignoring this whole cohort thing I told you about because,
yeah.
that's not really real. So you have to sort of, the company's trying to achieve like a steady state where it's not, in this investment period, but it's going to be in this investment period for a while. Only when it's the size of like Oracle will it be, in this period where it's not growing that much. And now look at HubSpot's growth: 47%, 33%, 25%, 21%. It's kind of slowing down. So like at some point they will be in a position of earnings. But let's say Google bought them out. If Google bought them out, let me show you real quick what this looks like. But
Yeah, so I'm basically, if I make things simpler, I'm betting on for PE to be lower in the future.
Well, let me show you.
Yeah, okay.
So let's say you're Google and you're looking at this and you're saying, what do I pay for this company? It has 50 million in net income. Okay? It's trading for 25 billion. So the market, obviously the PE ratio doesn't make sense. It's not 500 times earnings, right?
Yeah.
It doesn't mean anything.
Yeah, I know PE
Let me
ratio can
finish.
be...
Stop.
Yeah, sorry.
So basically you're going to say, listen, general and administrative, I basically don't need any of this because I have huge accounting firm, I have lawyers, I have all this stuff already. I might need 50 million, but I'm not going to duplicate all the costs. I don't need 2 CFOs. I don't need 2 tax teams. I don't need 2 auditors, right? So that cost goes down to 50 million. Sales team, same thing. I still need my salespeople, but I might not need as much of the same tools and salespeople that I need before. So maybe I save half on this. So it goes from 1.2 billion to say 600. And then finally R&D, I can cut that as well. A lot of those R&D tools are spread out across the company that Google will do more efficiently. So instead of 800, let's say I'm going to be spending 600. So now instead of 50 million in earnings, it's actually $1 billion. And that billion is much more reasonable. It's only 25 times earnings, and it's still growing 21%. So next year, this might be, 30%. And so with this, and maybe Google can even accelerate the growth. So now you're talking about 14, 15 times earnings. Pretty good because their cost of capital is much less than the return you would get on this, which is 7%. So it's that's kind of the way I would look at it. But you have to sort of adjust earnings for the reality. Anyway, appreciate your time, man. Thank you so much for coming. Okay, let's see. We got a very special guest here. Hello.
Hello.
Hi. Oh. Yeah.
Oh, okay. I'm through. Yeah. Hi, my name is Samir here. Jump show chat. I was interested to be a potential co-host, and as I know it's a long shot, but
I thought you were going to be a beautiful woman.
Yeah, if you want a beautiful woman, I'll gladly wear a wig.
Your voice is a little too low, buddy.
Oh, okay.
You're done. You're done now. You're done now. Get out of here.